Hey guys, Tony here. In today's video, we're going to clear up a couple of common misconceptions I hear repeated about GameStop almost on a daily basis regarding the adjusted EBITDA and the book value. We're going to clear those up for you to help you understand why the market is driving the price of GameStop down. And then we'll close out this video doing the weekly TA update for GameStop and talk about if I am ready to buy back into GameStop yet. Let's get right into it. GameStop investors put up a heck of a fight last week, keeping GameStop above that critical $10 mark. Short interest remains high around the 25% level, although cost to borrow is low, and we'll talk about short interest in just a second. But first, let's get out of the way this discussion about the adjusted EBITDA, and then we'll tackle the book value and then finish up talking about the TA. Understanding these issues and when you're getting good information versus bad information is critical, because we can look at a TA chart all day long, but that is not going to help us if we don't understand what is going on fundamentally on the play and what Wall Street is looking at and why institutions are so inclined to drive that short interest up and push this price down. So let's talk about the adjusted EBITDA. First of all, I want to say I think it's perfectly fine to talk about adjusted EBITDA as long as it is being explained in a proper way. And we see here from GameStop's Q4 earnings highlights that although net income was $6.7 million for the entire year of 2023, if we take out certain non-cash expenses, adjusted EBITDA would have been $64.7 million for 2023. The line that some people are crossing is telling you guys that these were one-time expenses and that they're going to go away and that you can count on that as future earnings. But when we look at the breakdown of how GameStop adjusts their EBITDA, there are three major contributors to the adjustments. One being the interest income, and the second two being depreciation, amortization, and the stock-based compensation expense. And the problem is, guys, is that depreciation, amortization, and the stock-based compensation expense are not one-time items. These are not just going to magically go away, and so it is a very unfair argument for someone to tell you, if you just look at adjusted EBITDA and forget about these one-time expenses, we're going to be fine. Please, guys, do your own due diligence and look up the history of depreciation, amortization, and stock-based compensation, and you will see that these are not one-time expenses. In my financial tracking and forecasting model for GameStop, I do have these two items highlighted for you going all the way back to 2016, highlighted here in yellow. It is clear that they are not one-time items and they're not going to go away, unfortunately, in 2024. Now, I do think it is reasonable to presume that the depreciation and amortization expense will go down a little bit in 2024. Just look at the trend down here every single year. So we have an idea how that is going to look. What about the stock-based compensation? Because it's a little bit more all over the map. We have a breadcrumb in the 10K from GameStop letting us know that as of February 3rd, 2024, there was $78 million of unrecognized compensation expense related to non-vested RSUs that is expected to be recognized over a weighted average period of 2.4 years. That gives us about $32 million per year of stock-based compensation expense that you should be expecting to show up on future 10Ks. In summary, I want to say it's fine to look at adjusted EBITDA. GameStop provides this so that you have an alternate way besides the normal GAAP numbers that are reported to the SEC to evaluate the company's core operating performance. Just make sure that when you're looking at these numbers or you're listening to someone, that you know what is a one-time expense and what is a recurring expense. That way you can evaluate the information that you're being given to see if it is truthful or not. Let's move on to the second topic that is commonly talked about out there in the social media community, GameStop's book value of $4.39 a share versus its current share price of about $10.42. The common argument is made that every other company's share price is much higher than its book value, and GameStop's share price being so close to book value must scream that it is undervalued at $10.42, right? Personally, I find this a bit of a red herring argument used to mislead people that aren't familiar with the proper way to do financial analysis. Very few, if any, people would only look at book value when trying to determine if a stock price, the share price out there on the market, is correct, is overvalued or undervalued. Although with GameStop, it is not the case that the market cap is underneath the book value of the company. If it were, then you could make an argument that a company is undervalued. This was, in fact, one of the key arguments of Keith Gill, or Roaring Kitty as we know him, when he was evaluating GameStop being undervalued, because its market cap at that point being only a couple $100 million was underneath its book value. When the market cap is below the book value, then it's a very easy judgment call that the company is likely undervalued. In the case of GameStop, where we're sitting right now, the market cap is well above the book value, so we can't use an undervalued argument. If cash on the balance sheet, 2 cents per share in annual profits, and book value versus share price are the three things you are using to analyze if GameStop is fairly valued or not, you are going to end up not analyzing this play like Wall Street is, and likely end up being on the wrong side of this trade, maybe paying too much for the stock when, if you want to own it, you could wait for the price to come down a little bit further. So a great question you might ask yourself, and one that I ask myself every single day, is what is Wall Street using to analyze what is a fair price for GameStop stock? And a lot of it, guys, has to do with earnings. I know that is a tough subject, and hopefully they get better, because increasing earnings is one significant way that you could see some institutions start getting behind GameStop stock. What is Wall Street looking at though? Right now, they're looking at things like the price to earnings ratio, which at the whatever it is, 500, 800, 1,000, it is clearly overvalued because the earnings are just too low relative to the price. The other thing that anybody in finance doing some sort of real analysis on GameStop is going to be looking at would be enterprise value. And that is a whole topic for another video, but you guys can start looking into it on your own. I would point you to a couple of key things like the EV to EBITDA ratio or the EV to free cash flow ratio as a starting point to do some comparisons of GameStop to its peers and see how it stacks up. I can tell you that the numbers here on the screen don't look very good if you're looking at enterprise value and the ratios derived off of it. The point of this discussion regarding the PE ratio and the EV to EBITDA, EV to free cash flow, is that we can't cherry pick our metrics in saying that something is undervalued. Wall Street is not looking at 1, 2, or 3 things. They are looking at a lot of things. And if you're not doing the same, you're going to miss the boat and pay too much for this stock, or you're going to pay too much and hold it while Wall Street drives it down, because they are looking at the proper metrics, the full set of metrics and ratios. That is why the short interest is high. That is why they are shorting it. And yes, if Ryan Cohen or GameStop comes out with a surprise announcement and having the benefit of no debt and $1 billion cash on the balance sheet and that high short interest, the shorts could absolutely get caught by surprise. And that is a wager, a bet, a speculation, a gamble that many of you are willing to take. And I have no problem with that if you want to do it. Knock yourself out. But for those that are wondering, why is this price being pushed down when I'm told that the book value is so high relative to the price, or that we are profitable in GameStop and there's no reason for the price to go down? Guys, I want you to understand that Wall Street is looking at much more than you are. And if you spend some time learning about everything that they're looking at, a lot of the price action will make more sense. In the meantime, I'll be there with you, crossing my fingers that that magic announcement from management at GameStop comes out. But for now, I am not buying GameStop. I will wait for that announcement, or I will wait for the price to come down. And speaking of price, where am I on deciding if this is a momentum trade for me to get in just yet? Looking here at the daily chart, we can see that we had 5 days of back and forth between the bears and the bulls, between 995 and 1070 or so. Really undecisive what is going to happen next week. All of the moving averages are still bearish, although we do have a low RSI, and the MACD down there at the bottom is really trying hard to curve upward. While GameStop investors try and figure out who is going to win next week, the other thing that we're really going to need to be looking at is the macro environment in the market. If the market decides to take a nosedive next week, don't be surprised if your favorite stocks take a flush right along with it. When I looked over on the hourly chart for GameStop, there is some resistance up there at about 10.55, so that'll be a key level to watch into next week. If GameStop can break through that, maybe they can push up a little bit higher. In the meantime, for me as a momentum trader at the moment, waiting on GameStop to have an earnings call, tell us some more information, drop an announcement about some surprise new strategic direction. For me being a momentum trader until then, I am going to continue to wait. If the stock continues to trend downward, as we've been saying for the past 3 weeks, it could trend sideways or downward in this channel for a long time. And I will continue to wait and see if we get some sort of support down here off of this blue line. That is what really gets me excited about an opportunity to purchase some GameStop, maybe for the big upward swing. That might take days, weeks, or months, and I am very patient. Leave me your comments or questions down below. I love to hear from you guys. I am Tony Denaro, and I will see you on the next video.